American Chemical Corporation case assignment by John DeFuria for Dr. Shiroki and the final for Finance 139. How was the past performance of ACC? American Chemical Company had its sales and net income increase from 1974 to 1978, except for 1975, which had a 3% drop in sales and 61% drop in net income. The company also was back on track and had increases for the next few years. The dividend per share had also had a steady increase over the 5-year period, and the stock's price increased in 1974 from $19 to its closing price of $44 in 1978. Standard & Poor's rating gave American Chemical Company a rating of BBB/A for the years from 74 to 78. The overall assessment of American Chemical Company based on the company's financial statements is that they are doing quite well. How is the competitive environment? Sodium chlorate and chloride dioxide are two very important chemicals in the paper making process. Chloride dioxide is used to bleach the pulp and used in making paper. Chloride dioxide is made from sodium chlorate. The demand for sodium chloride is expected to grow at a rate of 8 to 10% per year. The pulp sector is also expected to grow at a rate of 3 to 4% per year. The competitive environment at ACC in Collinsville is very tough. There are many competitors in the industry, and they must compete against them. There are two main firms that announced plans to construct new plants in 1980. Union Chemicals Corp. And Louisiana Paper Company are expected to build a 40,000-ton and a 35,000-ton plant respectively, which will create even more competition in the industry. They need to buy Collinsville plant to keep up with the demand and also to nip the capacity and yield lower margins and decrease capacity utilization for all companies that are in the industry. What is the unlevered and levered beta, cost of equity, cost of debt, and WACC? To find the levered and unlevered betas for Collinsville plant, I first needed to select two companies in the same industry that produces sodium chloride and average them together to come up with a usable unlevered beta for it. I have selected Penwalt Company and Georgia Pacific to come up with the beta for Collinsville plant. It comes out to unlevered beta average from those two companies of 1.0052 as a beta. When leveraging the beta with the debt equity ratio of 0.35 of debt and 0.65 of equity, the levered beta comes out to 1.54618. The cost of equity was then computed with the CAP-M pricing model, and with a risk-free rate of 9.5% and a market risk premium of 7.5%. I then took the 1.546 levered beta, put that in the CAP-M pricing model, and came out with 21.096%. Now with the cost of debt, which was given to us at 11.25%, and to find the cost of debt after tax, it was given a tax rate of 40%, and it came out to 6.75%. When putting all those calculations with the debt equity ratio and stuff into WACC, I then came up with a weighted average cost of capital of 16.07%. Next we'll get to the free incremental cash flows. This was taken by projecting future cash flows, and it was in the attached Excel spreadsheets if you need to look at the exact figures and how numbers came about. For the net present value for the first 5 years of the project without the laminate technology, came out to negative 1956.09, and the full 10 years of the projected future cash flows came out to negative 856.88. That shows that without the laminate technology that Dixon should not take on this project. Now with the laminate technology, it worked out to a positive NPV of 5760.18. This was not taken in consideration the $2.25 million that would be to buy the technology. It was only the $12 million for the initial project. So taking the $2.25 million, you can see that the NPV comes out to $3,510.18. and this gives us a range, as you can see, at negative 1956 to positive 5760.18, and this was only positive due to the laminate technology, which should better the company's project figures. What are some of the strategic issues? Acquisition of Collinsville plant would fit well with Dixon's strategy of supplying chemicals to the paper and pulp company's industry. Sodium chlorite would complement Dixon's product line. They already at this time do business with some of the Collinsville plant's major customers, so this would eliminate the transition. Sodium chlorite could then be marketed by Dixon's existing sales group. These points brought up would cut down on some of the costs associated with the purchase of the plant and the laminate technology. One major strategic point is that it would increase their market share and get them into a new industry without having to pay a lot of upfront costs, since sales and marketing could be added to their current divisions. As long as they do invest the extra $2.25 million for the laminate technology, it would be a wise and strategic advantage for them. As an independent consultant, I would recommend to management to make the purchase of the Collinsville plant to increase their market share and also to get them into the sodium chlorate business. The one main stipulation would be that they would need to purchase to include the laminate technology. Without the technology, they would have a negative MPV, and I would recommend that they do not buy unless they do take on that new technology. It will add an extra $2.25 million into the investment, but as you've seen on the previous slides, it will create a positive MPV, and it should allow them to move on in the future with positive results and increase their growth potential and continue on for future years. Thank you, Dr. Shiroki. It's been a great class, and I wish all of you that are hearing this the best in the future. I am graduating, and I am out.